there's a bit of a paradox here. We see geopolitical volatility that we haven't seen in decades.
Either consumers have less disposable income or companies have less revenue and perhaps less margin.
We have a market that thinks it understands where the president is headed.
This was going to create a US recession. This was going to create a global recession. Welcome to another edition of What's Brewing with Matt and Guy. Matt, we're sitting here in the middle of summer, the sun is shining, but the world is not a great place again. I mean, it's never ending in terms of the things that we've got to speak about. So what are you thinking?
So what I'm thinking, Guy, is there's a bit of a paradox here. If I look at the world through my political lens, it keeps surprising. We see geopolitical volatility that we haven't seen in decades, and yet markets keep going up. Why is this? Why have we got this disconnect?
Do you want to swap roles for a bit, just so you can see the light?
Yeah, feet up and a bit of relaxation would be nice.
So look, I mean, I think it's a very, very good question. I mean, I'm asked this a lot. People saying it can't disconnect. Why are the markets hitting record highs as they are today? Yet, as we've said, the world is a challenged place. When we had the situation with Iran, the market continued really to move up because financial markets, investors were saying, look, this is not going to impact fundamentals. It's not going to impact corporate earnings. It's not going to impact corporate margins. But what was different was back in April when we had the tariff tantrum, the Liberation Day announcements, the markets began to wake up and say, hang on a minute, this really could impact earnings and margins and growth prospects, because a lot of the tariffs that were being spoken back then were really penal. This was going to create a US recession. This was going to create a global recession. And from a financial market perspective, if it impacts earnings, that's a problem. But since then, we've moved on.
We're here in July, right? Start of July, when we were expecting all of these trade deals to be done, the threat of tariffs still hanging like sort of Damocles over companies around the globe. Markets are calm.
Yeah. So what's happened? We went into a bear market, as I said at that time. Markets were down in many cases over 20%. But then we had a change. So what changed? Well, the US President Trump, he backed off in terms of his rhetoric around the Fed, for example. They were concerned about the move of the markets. They realized this could become really unsettling. So they stepped back. And in addition to that, what also happened, of course, was the tariff threats were also scaled back. We had the window, the pause for the 90 days. Since then, we've seen a couple of minor deals being done. But again, the financial markets are saying, look, this is not going to be as penal as we had first thought. Clearly, the US president doesn't want a deep, dark recession, and he certainly doesn't want a bear market. And if you have that, you can parameterize this.
We have a market that thinks it understands where the president is headed.
Yeah.
But if I look back at what is underpinning Donald Trump's agenda when it comes to trade, he's been extremely explicit, very clear. This is about fundamental shifts in balance of trade. This is about bringing jobs back onshore. This is about bringing manufacturing back into the US. That will come with a cost, won't it? I mean, are markets being too sanguine?
Well, first of all, Matt, you're looking at things way too fundamentally. From a market perspective, the markets have kind of won out because they forced the president's hand. When we had the markets down 20%, when we had bond yields spiking, it was the mighty financial markets that frankly turned the administration's, at least rhetoric. So the first point I would say is that the strength is ultimately in the hands of the markets, not the politicians. But to your point, yes, I would argue rightly that a lot of the policies that are being implemented, certainly in the short to medium term, are going to be negative. It means that we're going to have not only higher tariffs, meaning that either US households pay for that or US companies pay for that. So either consumers have less disposable income or companies have less revenue and perhaps less margin. So that's a real concern. And it does mean to say that I think the markets have to be aware that the environment is still highly unpredictable. But again, they're looking forward and saying, look, we've had the pain of tariffs, we've had that uncertainty.
But hang on,
we can move on.
Have we had the pain? Because there was a big wobble at the start of April. There was interruption to imports coming into the US. There is a sort of price shock that's somewhere in the system.
Yeah.
And that will have political consequences, won't it? I mean, when people see they can't get hold of goods or prices are going up, they're not going to be happy.
No, and I think you're absolutely right there. We're still in this period where we haven't really seen the major impact from tariffs, either in terms of goods availability, accessibility, nor in terms of the price that are being paid. We've seen a little bit of this. If you look, for example, at the revenues generated in the month of May from tariffs, they spiked. There were about $20 billion coming in, which looks a lot. It looks dramatic in the chart. In the scheme of the US economy, it's not massive. But the point is that when you look at that 20 billion, that's being paid, as I said earlier, not by the Europeans or the Chinese, it's being paid by America itself. So you're right, I think the growth dynamic is going to be slowing down. The labour market has held up quite well, but we're again seeing at the margin an erosion of that strength. We're lucky because the US economy has been very strong, but it is certainly weakening. And that will be a challenge, I think, as you get into the back end of this year. And yes, that will create perhaps some pushback against some of these policies, at least from a presidential popularity polling perspective.
So look, the other big development since we last spoke, certainly on the US side of the Atlantic, is the signing into law of the big, beautiful bill, as it's been branded. But that bill confirms that the US budget deficit is going to increase in coming years. There are significant tax cuts, but there are also significant paring back of spending, federal government spending, and that will have consequences again for voters. Markets seem to be fairly relaxed about this. So politically, it's an interesting story, but it seems not to have really ruffled feathers at all in markets. Again, we see a sort of disconnect between the political and the economic.
It's taken quite a long time to come to get to this stage. We've been anticipating this for a number of months. It tends to be front-end loaded in terms of the stimulus element, and I think that's one of the things that the market is taking heart from. A lot of the other issues around the deficits and maybe paring that back, certainly not enough, I think, from a market perspective, but it is out there. But this will put pressure, I think, ultimately in terms of bond yields. It still means that I think investors are going to demand a higher premium in order to lend US government money because that debt and that deficit levels are continuing to increase over time.
So look, I think we have to price in this sort of news flow volatility in terms of policy announcements for the next few years. I don't think that's changing. I think the critical question is, does that really impact anything fundamental about the way the US operates, or our ability to predict over the next 2-3 years the landing zone for US policy? And when we've talked in the first half of the year, I think there were points where there were real question marks over how fundamental a shift we might be seeing in US positioning, particularly on relationship with Europe, commitment to NATO, and that seems to be in a more settled place than perhaps it was 2-3 months ago. We've had NATO summit that passed off without significant incident. We have the Europeans towing the line in terms of commitment to 5% of GDP on defence. So, I mean, an interesting question there in terms of how that plays through into European economic outlook.
So what you're saying, though, is policy is working. I mean, you asked me about the financial markets. Why are they in sort of good spirits? Well, you've just said that a lot of the Trump initiatives are working. They are getting Europe to pay up. They are more commitment coming through to NATO.
But look, I would caveat that with they have got the Europeans saying things to satisfy the president. Let's see how quickly that translates into actual money. And it'll be a while before there are sort of European tanks defending the European borders in numbers that are required. When we look at Europe, I think the real question is how do Europeans take forward the commitments to big additional spending, particularly on defence, but they're still facing, gaps in investment around greening European economy, digitising European economy. We all know what needs to be done. Question is, can politicians turn sort of rhetoric into action? And we're not going to see an outcome on that quickly.
But this has got to be the opportunity. If they don't take it now, will they ever?
If you look at this from just a straightforward economic perspective, right, you'd say thing that's going to really shift assumptions about productivity growth and future GDP growth in Europe is accelerated adoption of cutting-edge technology, particularly AI and the sort of use of data, right? Quickest way to do that will be to import that expertise from the US, is to use the expertise that's there in US firms, it's coming out of Silicon Valley. But politically, you're very nervous about doing that in a context where you're much less certain about the reliability of the US and alignment of interests between US and Europe. And that sort of knock that came with J.D. Vance at the Munich Security Conference, that's come with some of the rhetoric from President Trump, I think that sort of flies in the face of doing what might make sense from a
Look,
quick boost to productivity.
I would agree with all of that. I think it's unfortunate. I think that the US has shot itself in the foot a little bit in terms of this. But if you think about the tariff situation, I think Europe has got some incentive to buy a bit more from the United States. And high tech is one way of doing that, helping to right that. So I would say, again, it's not a sea change there, but at the margin, it's likely to move in that direction. But I think your point is a valid one, is when you're dealing with so many different governments, so many different regulatory environments, that has to change if Europe really is in the long term to be in a much stronger footing. And to me, for example, we still need to see, a capital market union. We've still not had that. To me, that would be a game changer. Would you agree with that?
I completely agree. And I think we need to keep a close eye on the savings and investment union. We'll get a strategy or a further set of proposals from the European Commission second half of this year. And that's the sort of the next phase on trying to get capital markets really up and running in Europe. So
well, let's see, because to me that has to happen. Because if that doesn't happen, I think your arguments are valid, and we'll see just a cyclical upswing in these markets, and then we find a downturn to come. But let's keep our fingers crossed that we do see some real change here. So Matt, another great session, so much to talk about. I suspect when we come back after the summer, there's going to be a lot more, given what you implied about the policy situation. But for now, to all our viewers, thank you again so much for watching. Remember to like, subscribe, and do hit that notification bell, and we look forward to seeing you again very soon.